most fundamental thing that we pay attention to is the difference between long-term and short-term rates. So advising, and again, we're not trying to avoid paying tax, because even if the implication of tax is that we are going to end up paying the highest ordinary income rate because we didn't hold the asset for more than a year, then we do it if that's the right thing to do for the portfolio. But there is the difference between long-term and short-term rates is a tax-aware focus. How we set up assets, it's called asset location, and it's a matter of, do we have income generating types of securities, bonds, dividends, et cetera. Those should be allocated to a tax deferred account as opposed to a taxable account. And then there's also, I do use ETFs, which are inherently innately tax focused, or they do have that element of tax for tax aware investing, because the difference between that and a mutual fund, for example, is if you own you bought a mutual fund in June and it goes down, you could very well owe tax despite that, because of the load that the tax burden that was carried when you bought it. So ETFs are also tax efficient. The biggest mistake is there's a lack of focus on setting things up with the implications of tax. Tax is the number one drag on wealth, certainly when you get into those upper brackets, and not paying attention to what tax is. I continue to be surprised by the size of the portfolios that are being brought, and people aren't discussing it at all. So people know about tax loss harvesting. That's easy, but there's a lot more that we can do to eliminate tax, and with the implication of the far-reaching, keeping that money in your portfolio, keeping it in your pocket over a number of years, over applying these strategies over a 20-year period, it has a significant impact on the portfolio.